You're about to listen to the Yet Another Value podcast with your host, me, Andrew Walker. It is December 2025, December 23rd to be specific. Today, I am recording my monthly random rambling. We're going to get there in 1 second. I've got about 4 topics we're going to talk about. I have a general thesis on why I think the stock market is getting weirder and weirder over time. We'll dive into that. I've been quote unquote investing professionally in the public markets for 10 years. I've got kind of stuff that I've learned and thought about and changed my mind over the past 10 years that we're going to talk about. And then I've got a real ramble that just comes out of nowhere and I have no clue where I'm taking it on on arrogance, expertise, risk in the public markets. I don't even know where I'm going. I say this every month in my random ramblings, but this is probably my randomest, ramblingest ramble yet. But I hope you enjoy it. I hope you have a great holidays. We're going to get to the random ramblings in 1 second. But first, a word from our sponsors. This podcast is sponsored by AlphaSense. One of the hardest parts of investing is seeing what's shifting before everyone else. For decades, only the largest hedge funds could afford extensive channel research programs to spot inflection points before earnings and stay ahead of consensus. Meanwhile, smaller funds had been forced to cobble together ad hoc channel intelligence or rely on stale reports from sell-side shops. But channel checks are no longer a luxury. They're becoming table stakes for the industry. The challenge has always been scale, speed, and consistency. That's where AlphaSense comes in. AlphaSense is redefining channel research. Instead of static point-in-time research, AlphaSense Channel Checks delivers a continuously refreshed view of demand, pricing, and competitive dynamics, powered by interviews with real operators, suppliers, distributors, and channel partners across the value chain. Thousands of consistent channel conversations every month deliver clean, comparable signals, helping investors spot inflection points weeks before they show up in earnings or consensus estimate. The best part is that these proprietary channel checks integrate directly into AlphaSense's research platform, which is trusted by 75% of the world's top hedge funds with access to over 500 million premium sources. From company filings and broker research to news, trade journals, and more than 240,000 expert call transcripts, that context turns raw signal into conviction. The first to see wins, the rest follow. Check it out for yourself at alphasense.com/YAVP. That's alpha-sense.com/YAVP. All right, hello, and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. With me today, it's me. It's just me on for my monthly December 2025 ramblings. For those who don't know, once a month, I try to hop on and just ramble for 25, 30 minutes about different things on my mind. So that's what I'm going to do today. Before we get to that, let me just disclose nothing on this podcast is investing advice. That's always true. But again, today it's just me going on and rambling for 25 to 30 minutes. Do you really want to listen to somebody who just take 25 or 30 minutes out of their day to scream like a maniac into a microphone? I certainly wouldn't. So you shouldn't either. What do I have on my mind today? Let's start. Well, first, I had a baby, so I haven't talked to everyone since I had the baby. It's going, I don't know if well's the word. The baby is healthy, but oh boy, is I'll hear from my friends, oh, our baby sleeps for 6 hours a night. It's just so hard to wake them up to feed them. That ain't the case here, folks. I'm tired. But you don't care about that. Let's talk about what I want to talk to you about today. Oh, one more thing. I'm recording this on December 23rd. Obviously, holidays are coming up. Want to wish all of you happy holidays. One of the fun things about running a podcast that I have dozens of listeners to is 5 or 6 of you have thrown me on your Christmas mailing list. And for maybe 3 of the 5 or 6, I email with you every now and then. And for maybe 3 of the 5 or 6, I've never emailed you before. But I get them every year, and it's kind of like the 4th or 5th year in a row. And it really tickles me. And I really enjoy following these families I've never met. So I think the Yet Another Value Empire has a great community. I want to express my heartfelt warm wishes to those of you who've added me to the mailing list or, who just listen to this in general. Okay. What do I want to talk about today? I have been, quote, unquote, professionally publicly investing. Again, heavy on the air quotes, because in my mind, I'm still a teenager sometimes, but I ain't a teenager anymore. If you're looking on the video, you can see the grays are really starting to come in. I've been, quote unquote, professionally publicly investing for about 10 years, kind of been professionally investing a little bit longer than that. But, this is about my 10-year anniversary. So working on, annual letter, 10-year letter, all that type of stuff. And I'm just kind of using this podcast, this ramble to soft run some of the things that have been on my mind, some of the things I'm thinking about, some of the things I'm trying to finalize on the letter. So let me start with this. Just high level outlook, done this for 10 years, take a breath, look out the next 10 years. I have a thesis, and again, I'm soft running this. I'll write more about this if I think it's correct. I won't write more about this ever if I think it's wrong, but I have a thesis that markets are getting weirder over time. And let me tell you how I think about that. In every sport, as things evolve, strategies go kind of to the far edges of strategy. I'm a big basketball fan. Mention basketball all the time. About 10 years ago, the mathematicians realized, hey, the optimal shot is either at the rim, at the free throw line, which you generally get by getting at the rim, or a three pointer. Everything else is a waste. And you saw, today when you play basketball, in professional basketball, it's increasingly rare for any shot to come that's not directly at the rim or a three pointer. Every other shot's inefficient. They've been gone. So we've gone to the extremes of the mathematization of basketball, and you do see like there is kind of a counter strategy where, hey, maybe if we play in the mid range because defenses don't even guard that anymore. But we've gone to the extremes in chess. About 7 years ago, AI really starts coming for chess. I believe it's AlphaGo or whatever. It takes over chess. And high-end chess games between computers 7, 10 years ago, whatever. I've got lots of articles. They stop resembling what a chess game between me and you, whether, I'm just a putzer when it comes to chess, but even if you were a high-level person, high-level chess games stop resembling what humans play. It just looks like a completely different sport. And that happens over time in all sports, right? As they get advanced, they stop looking like what normal people play. Just, again, to go back to basketball. If you and I went and played, we jack up some threes and everything, but the NBA game is completely different because we can't dunk. Less than 1% of the people on Earth can dunk. The NBA is played above the rim. Normal people play below the rim. As you get special, the strategies change. Why am I saying that? I think when it comes to the stock market, I think the stock market is getting, as we've entered kind of the final stages of the efficient market, I think the stock market is getting weirder and weirder. And this probably starts happening about 5 years ago, with the SPACs and the post-COVID boom and everything. But it's fueled by zero-day trading. It's fueled by levered ETFs. It's fueled by the rise of retail, all this sort of stuff. Prediction market, everything's like blending together. But I think the stock market's getting weirder and weirder. I've used the quote several times. If you come to me and said, hey, this stock's trading for a 5x PE, I think it's a buy. That would have been a great thesis in the 1960s. Today, that thesis is dead on arrival. Quants and computers have picked over that simplistic model. I think the market's getting weirder and weirder over time. I think we're going to see the market continue to do weird things, whether it's big jumps, big drops, spikes. I will tell you some of the leaders in the year-to-date returns category for individual stocks. I look at these companies and it seems pretty obvious to me that the long-term path there trends to zero, but what a run you can have in the short term. They're 10Xs over the past year, and sometimes you can get some path dependency. But I think the fundamental alpha is gone because of computers, because of all this. And I think increasingly we're going to see weirder situations. We're going to see weirder things happen in the stock market. I think that's where the stock market's going. I don't know if I'm crazy. I don't know if any of that makes sense, but I think where we're going in the stock market is akin to what happens in chess, akin to the specialization. The normal stuff is gone, and where all the returns, where all the juice, where all the edges is on the weirder stuff. It's people who I don't ever want to do this, but I think there will be a lot of alpha being made by the people who follow the open door, create a cult around the stock and be early and create a cult and drag a lot of attention to it. And look, whether I'm not saying pump and dump, but open door recreates themselves, right? They get this mob army, the stock goes up 20x, they can issue equity, they can bring in a new CEO. Like I think stuff like that, which is clearly at the far edges of fundamental value and everything. I think we're going to be seeing a lot more of that. And I think investors who can adapt to that, can adapt to weird situations, I think that's where we're going to see a lot of edge going forward. Now, I'm not saying there's not room for great fundamental analysis. I think it's almost table stakes. And I think unless you're really, really great at the fundamental analysis, really on the edge of that, I don't know if there's going to be a lot of alpha just for pure. I don't think there has been over the past 5 years, but I think it increasingly goes away because that side of the market is efficient and that's table stakes. So I don't know. And look, maybe I'm pushing my own book, talking my own book here because I love weird situations. That's what I have been doing for the past 10 years. And to my chagrin, it's to my chagrin that I've done anything else. And I increasingly lean into the weird situations. That's what I do. So maybe I'm talking my own book, but that's just kind of like when I think about the past 10 years and the next 10 years going forward, that's how I kind of think about markets. And maybe I'm crazy. Maybe I didn't define it properly. Again, this is my rough draft. I'll work on defining it better. Let me go to the next thing. Again, when I look back over the past 10 years, Charlie Munger, RIP, I think more and more of him every day, more highly of him, but I do think about him more often every day, I would say. Charlie Munger once said, if you go a whole year and you haven't changed your mind on anything, it's a waste of a year. And so I've kind of been thinking about the past 10 years and what I've changed my mind on. Now, here's the funny thing. if you change your mind on something, unless you're like taking notes and say, oh, I changed my mind on something, like, look, you can change your mind on a stock and say, I used to think it was a buy and now I think it's a seller. Now I think it's sold. Yeah, it's pretty easy. But when you change your mind on something big, it's actually hard to remember when you've changed your mind on something. So when I first went to look, I said, oh, I haven't changed my mind on anything. And then as I really started thinking about a lot of things, I realized, oh no, I've changed my mind on a lot. But I feel like there's a lot more. But here's some things that I've changed my mind on that I remembered I've changed my mind on. I'm sure there's a lot. My first uh, I just say pure valuation metrics. Like I increasingly, yes, it is nice to buy something for 8 times price earnings. Yes, it is nice to buy something for price to book. I still find myself being pulled towards those metrics, but I increasingly believe that if the core of your thesis is simply, hey, this trades cheap on an LTM earnings multiple, you will find not only no alpha there, but probably negative alpha. Now, maybe I'm a prisoner of the moment. Maybe I'm a prisoner of the past 10 years have been really great for growth companies. But, it just strikes me as if your core thesis is something that I use this line all the time. If your core thesis is something that can be recreated by a Yahoo Finance screener in 5 seconds, you're probably not going to get paid for that. Now, maybe somebody can come and tell me I'm wrong. Hey, if I run a diversified basket of 50 low price to earnings companies, then I'm going to eke out a little bit of alpha. Maybe, but for the big alpha, I kind of doubt that you're finding it there. So that's one thing I've divorced my mind on. I think another big thing that I've changed is I've only been doing this podcast for 5 years. I've been writing the blog. I've been writing publicly on and off for the majority of the time. But I think if you came to me 10 years ago, when I look at the early investments, it was John Malone. It was levered return on equity stories, big free cash flow, lots of repurchases. And that hasn't worked. Those investments generally have not worked out well. And I still love repurchases, but I increasingly, you know, maybe it was selection, right? Because the companies that were doing big repurchases 10 years ago, 5 years ago, tended to be companies that had big legacy moats, lots of free cash flow, no area to reinvest. And guess what? Basically all the tech companies came and ate their lunch. The headliner would be Netflix coming and needing all of the cable networks lunch, but you can go across the board to through a lot of them. So maybe it's that, but increasingly, like, I used to look and say, oh, these guys have repurchased 15% of their shares over the past year. That is a huge buy signal. And now I like it. I think the repurchase is a much more capital efficient return than dividends. I do like that I own the company. I own a little bit more of it every day if they're buying back shares. International market, I've mentioned this on a few recent podcasts. I love in the UK that they file their repurchases every day. So every day I can say, hey, I own a little bit more of this company and I can kind of track their allocation that way. But, I would say repurchases over the past 10 years have become a much smaller part of my investing style. And you can only watch someone like Bed Bath and Beyond is the famous example. Buying back shares at 40 and then they're death spiralishing shares at 10 cents on literally 10 cents on the dollar, like not 10 cents on the dollar in terms of intrinsic value, but no, like 10 cents per share, increasing them in a death spiral 18 months later, maybe, if even that. The department stores are obviously great examples of these. Oh, department stores, actually, off the top of my head, that's another one. Real estate in the public markets. When I started, I would look a lot for companies that had hidden real estate, right? Especially restaurants have them all the time. Restaurants that have been around for 50 years have 200 chains. They are kind of owning and building their own boxes. I used to look for those a lot. Now, a lot of the restaurants have gone because private equity kind of came and picked them over. But all the department stores, I think 10 years ago when I launched, I was still really interested in the department stores. Seritage would have been the big one. My God, the Seritage theses were unbelievable when they came out, right? Like, to a value investor, you had a spin off with a rights offering with hidden real estate, all this sort of stuff. Disasters across the board, disasters. All the department stores, Macy's, Kohl's, Nordstrom's, and yes, you could get, if you traded them well, you could get one nice pop up from them. I know many people have and did, but in general, you look at the 10-year charts, they've been a disaster. And this is despite them saying, Macy's owns effing Herald Square in New York City, and just none of them can figure out how to monetize. And it is for the department stores. It is kind of, look, you have all of this real estate ownership attached to a truly negative EV department store business. And the issue is the department store business consumes value every year, at least in my opinion. I think that's the issue. But I've become really disillusioned with trying to find publicly traded, like kind of hidden real estate assets. So that's another one. Repurchase I already mentioned. Technical analysis. 10 years ago, 7 years ago, 5 years ago, 3 years ago, I was a 0 out of 10 on technical analysis. I thought it was complete mumbo jumbo, complete voodoo, all that sort of stuff. Honestly, I still do. I don't do any of it myself, but I would say I'm kind of like a 1 out of 10 now. I don't do it, but I do think there is something to, especially on the short side, I think there's something to technical analysis where, like, hey, and I don't do a lot of shorting, but hey, the 200-day moving average or something, you probably want to be aware of that if you're shorting something, just like as a rule of thumb. I do think RSI measures, like relative strength measures, when it comes to, particularly on the index side, when you're thinking about, hey, market's oversold, undersold, if you're thinking about when to deploy like kind of cash into a bottom, I think those are interesting. But I'm, I was a 0 to 10. I would just dismiss it. And now I'll kind of be like, if you want to talk to me about very basic stuff when it comes to kind of especially risk adjusting, risk parameters, I'll entertain it. So I think that's a big evolution, to go from completely dismissive to saying, hey, but that's one. And then the last one that I've really evolved on, I think 10 years ago, you would ask me, uh, a value investor, what do they do? I would say they go and they find a company that's undervalued. They do a ton of work on it, and then they hold it and they hold it and they hold it and they hold it and they hold it till the market agrees with them, right? Whether that's 3 years, 5 years, 10 years, 50 years, whatever, they hold it. Now, obviously, if the facts change, they change their mind and sell, but they don't. If the stock price isn't working, they don't let that hit them. And I've kind of come to the opinion of, like, look, if you buy something and then you hold it, and I think 3 years is the time frame, though it might be 5 years. You hold it for 3 years and the stock doesn't do anything, or it goes down. It's not that you must sell, and it's not that you must be wrong, but 3 years is a long time, and it's probably time to start looking yourself in the mirror and saying, hey, is it me or is it them? And I'll give you an example. I was and am a long time cable bull, though I don't own much in the cable sector anymore. I think I started becoming a bull in 2016, right? So that's about 10 years ago. And for 5 to 7 years, it really worked. And in the past 3 years, it's been terrible. And I think the past 3 years, the whole time I was looking at saying, look, competition's a little worse than I thought, but look at the cash flows, look at the asset value, all this sort of stuff. And I think the right answer was, hey, Andrew, your thesis was, the market is hitting you in the face with, the thesis is wrong. The thesis has changed. And better investors than me noticed that the competitive threat was ramping up, and that was going to be bad for cable. And the thought was it is either duopoly or monopoly, and fixed wireless has changed it to, it might be oligopoly in a lot of places. Now, a price for everything. But I think if I had been honest with myself years ago, I could have said, hey, I invested in this on a duopoly thesis, a monopoly thesis, and that has changed. I need to step back and sell and reassess. And I didn't do that. So that's just one that's really developed for me. But there are others, stocks I've held that I bought at 50 in 2019, and in 2022, they're still trading at 50. In general, if it's been 3 years and it hasn't worked, my history has been, you'd probably be better off selling and saying, hey, I missed something, and I can go invest in other things. And maybe I'll revisit this a year from now and see how things play out. And again, I'm not saying that works for everyone, but my history has been, I would have been better after kind of 3 years if something hadn't worked, saying, move on, do something new. So those are the things I've evolved on. Let's see what things that I talked about. I said disillusionment with free cash flow and repurchases. I said increasingly trailing metrics not applicable, going from a 0 out of 10 to a 1 out of 10 on technical analysis, and kind of, I call it timing out, after 3 years saying, hey, this hasn't worked. Let's stop saying it's the market. Let's start saying it's me, and moving on. One other thing I've evolved on. A friend tweeted this. I think he listens to the podcast, so he might recognize it, though he tweeted it about a month ago, and I liked it so much. He might have forgotten he tweeted it. Who can remember all of their tweets? Who amongst us? But one thing I've thought about was, and this relates to the timing out I just talked about, but one of the ways you mature as a value investor, I think, is along risk management sides. And again, this relates to the timing out, but I think when I started, I thought, hey, value investing is you buy something at 8 times earnings. And if it goes to 6 times earnings, you kind of suck your thumb and buy more or you hold or whatever it is. And I think mature for me, one of the places I've matured is you're a value investor. The stock goes from 10 to 8, and there's news, right? It's not just, hey, the market went down or whatever, but there's news. You need to be able to rip the band-aid off quicker. And I'm terrible at this. My instinct is to defend everything I buy. My instinct is the price. I liked it at 10. I want to love it at 8. But I think it actually is value investing is maturing and saying, hey, my thesis was wrong. I need to sell and move on. And, I can always revisit it or something. But in general, I found if something goes from 10 to 8, I would be better off selling than holding or buying more or anything. And I think that's maturation of value investors saying, hey, just because I bought it at 10 doesn't mean I need to love it at 8. It's time to reassess. Is the market telling me something? Is there new information? All this sort of stuff. Again, I'm not saying just because it's down, you need to sell, but generally when something moves down about 20% is where you probably saw some material news. And my instinct did, I've been using a value frame, but I'll use events. I buy something at 10 and it's rumor trage, right? There's a rumor that it's going to get taken out at 13 and I buy it at 10 because I say, hey, the downside's 9, the upside's 13. And I really think this deal's happening. And then the deal doesn't happen and stock trades for 9. I think 5 years ago, 3 years ago, even now, I'm always tempted. I'm like, oh, well, it's come to my downside. And yes, it's not going to get taken out now, but they were in play and, all this upside and stuff. Let's hold, let's wait. No, the answer there is you've got to sell, you've got to move on. I'm getting better at that. I missed it a few times, but my biggest losses have generally been when I bought something at 10 on an event, it trades to 9 when the event's dead, and I say, hey, this was an event, now it's a value investment, and then trades from 9 to 6, and I say, hey, this was a value investment, now it's a deep value investment, and then trades from 6 to 3, and I say it was a deep value investment, now it's a distressed investment. No, just got to move on. So I think those are the ways I've evolved. Those are the things I've changed my mind on, the risk management, over time, all of that. And again, evolving, still thinking about these thoughts, trying to write an annual letter. So if you've got thoughts on them, hey, shoot me an email. I'd love to discuss them. Uh, Last thing I wanted to talk about. This is something, one way I've evolved as an investor over the past 10 years is I've started to do the podcast, and I effing love the podcast. I learn from everyone. And I would say, if there's the bell curve, I think one of the nice things about my podcast is I hope my bell curve shifts far to the right, right? Like the average guest, I hope on my podcast, again, maybe I'm talking about a book, the average guest is a very above average investor, right? They're a professional investor, they're very above average. I've got great guests in my opinion. The above average guests and the best guests are just like far, far right tail. And I hope every episode, because I do a lot of work for prep, I hope every episode in terms of you learning something fundamentally is like on the bell curve, kind of shift right. But there is a left tail to my podcast. And I hope the left tail again is kind of truncated because of the work I do on it and the types of investor I have. But 350 podcasts, one in every 30 episodes is going to have a guest who, I get them on and I don't care if they're a dud in terms of, I don't need huge amounts of charisma on the podcast. I bring the charisma, right? I care about dud in terms of the guest, just, the fundamental work just wasn't there, right? And I'm not going to name any names, but of the past 300 episodes, I can think of a handful where that's the case. I learn something from every podcast, even if it's someone who's on that left tail I'm talking about. I learn a lot because when I kind of force myself to talk to them for an hour, if I'm seeing big holes in how they're thinking, I kind of have learned a lot of, I think one of the main ways I've evolved for the past 5 years is when I talk to people on the left tail of the podcast and I really have to talk to them because it's an hour, I learned the holes and the errors and where I think they're missing stuff, and I can apply that to my own investments. Anyway, podcast, coming back to it. I love the podcast. And one of the great things is I've got great investors is where I'm going on. But there is a line, some of the best investors by track record, I'm not sure if they are the best investors I've talked to. And I wonder if that's because it's me seeing holes in their thinking, or if it's, hey, these guys have done so much that these guys, sorry, they've got the best track record. And often it's one grand slam investment that separates kind of the people who have very good track records from unbelievable track records, right? And let's use VC, right? Two VCs who are equally smart. If one kind of got into the Facebook deal and one did not in 2009, the one who got into the Facebook deal is a legend, and the one who did not he might be okay, he might be average. But is there any different intelligence? Probably not. I don't know. But the returns are magnified difference. In the public markets, it's interesting because a lot of the return difference can be summed up to one great investment. But when you look at the investment, you wonder, hey, was this person, super smart? Or did they get lucky? Am I talking to this person and there's 10 other universes, and in 8 of the 10 other universes, this person is done so, right? They took this huge risk and it didn't work out for them. I don't know the answer, but the podcast is just like, it's been really interesting for me to talk to some of these people who've just hit absolute grand slams. And sometimes, I'll talk to them in the moment. And then 18 months later, the stock's up 6x and it was their largest position. And I can go and listen to the podcast and I can say, hey, I mean, this person, if it's your largest position and it's up 6x in 18 months, your near to medium term track record, at least if not your long term, looks pretty goddamn good. And, I can go look at the podcast and say, hey, was this person was a great guest, I'm sure, but was this person a, legendary investor, or were they a good investor who was a little bit arrogant, maybe, who ignored some risks and because of that was able to hold something up 6, 8, 10x? I don't know the answer. I understand it, that a lot of that sounds negative, but it's what I'm thinking about. Like, if you're going to have something that goes up 10x, often there is a risk. And did it go up 10x because you identified that risk and rightfully dismissed that risk? Or did it go up 10x because you've lost over that risk and you didn't know you were taking that risk? I think it's a fascinating idea. But I am hard rambling. Oh, here's one other area. Again, I just ramble on these things, but here's one other area where I think about this. Right now, Paramount, Netflix are trying to buy Warner Brothers. There's a bidding war there, and I'm very long Warner Brothers as a full disclosure. I am now seeing a lot of media investors and media commentators commenting on the Paramount, Warner Brothers, Netflix bidding war. And I think it's comical. These guys, many of them are very smart media investors, but when I hear them talk about the event of the bidding war at Warner Brothers, I find it comical, how wrong some of the things they are saying on. If you do event for a living, the beats and drums of some of these, and it's just like crazy how wrong these smart people are. And you see this and you say, hey, when I see them coming into a domain that I think I know a lot about, and they're just completely wrong on the mechanics of a tender or anything, how do I think about that when they're so wrong in this when I'm in their field? Is this just, hey, it's the shoe button expert thinking they know everything? Is this something else? I don't know. I mean, Twitter, I remember this happened a lot with Twitter when Elon was trying to buy them. You'd see very smart people opining on legal things. You'd be like, you have no idea what you're talking about. I mean, I'm not a lawyer, but I know how, kind of the contract law works on a job basis, and you hear opinions, be like, you have no idea what you're talking about. And this would go to, I mean, I remember the Delaware judge who said Elon would be able to get out of the Twitter buy for $1 billion. I'd be like, do you not know what specific performance in a contract is? So it's just another thought where, I don't know. It's just interesting. Are they such experts in their field and it's arrogance that they can come to another field? Does it show shortcomings in their current field? I don't know. Anyway, I'm rambling. I can feel myself rambling. You can probably hear me saying, man, should I be talking about this? Am I making any sense? I don't know. But this was my monthly random rambles for December 2025, 10 years as a quote unquote professional investor. I still learning. I just think about myself 10 years ago and how stupid I was. I'm sure I just mentioned arrogance and not knowing what you're knowing. Think about how dumb I was and how much of a better investor I am now. And my goal, my overarching thesis is I'm better today than I was 10 years from now. And in 10 years, when I've got a lot more gray in my head, I'll look back at this random ramble and I'll say, God damn, that guy 10 years ago, he was so dumb. He didn't know what he was talking about. I'm so much better than I am. I'm so much better today than I was 10 years ago. And I just hope, the great thing about, as I've said about investing, the great thing about it is you don't peak until probably your mid to late 40s. And I've got 10 years from there. And hopefully I'm kind of just hitting my stride. And that's the great thing when it compares to, I get sore when I lift nowadays. I can't row like I used to. But the great thing about investor is you've got a much longer career and much longer time frame to build on everything. So I'm looking forward to the next 10 years. I hope you're looking forward to doing the next 10 years with me. I'm going to stop myself from rambling and my rambling there. Wish you happy holidays. Wish you a happy New Year's. We've got some great podcasts coming up in January. Looking forward to those. Looking forward to rambling in January with you, and I will see you in the new year. A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.